how to analyze syndication, fees, structures. We'll take a look at 5 common fees, discuss what those fees are actually being charged for, what the industry standards are, and the red flags that you as a passive investor should look out for before investing in a syndication. Whether you're new to real estate syndications or experienced, I'm going to provide the basics, but also some high-level insights to improve your investing game. Number 1, acquisition fees. These are going to range from 1% to 2%. And what is this fee for? This is essentially all the work that the real estate syndicator had to do in order to bring this opportunity to the investors. To really paint you a picture, this involves developing a whole broker network and relations, to go to conferences, constantly talking to brokers and people that look for deals to be able to actually get access to these opportunities. Then it's also about underwriting these opportunities. Sometimes you need to look at 100 different deals, go through all these analytics before you even put an offer in. So there's a lot that goes into acquisition. Also, there's legal, there's going through the closing process with the brokers and the buyers, the negotiating. So there's a lot of work being done to earn the acquisition fee, and the range is about, like I said, 1% to 2%, depending really on how good of a deal is it. So once you have experience on different deal types, you're going to be able to see, wow, this is a really unique opportunity in the market, and sometimes a 2% fee could be justified. But if it goes over 2%, that's where if I was a passive investor, I would start asking some questions. Now, some other questions that I would ask if I was a passive investor is, you, the sponsor, are you planning to take this acquisition fee and roll it in to the property as equity? So in the industry, what happens is sponsors usually put a percentage of their own money into the deal. Now, sometimes sponsors will try to roll in their acquisition fee and say, hey, I'm putting my money in. But really, they're not going into their bank account and putting the money into the deal, right? They're putting the money that they're earning in commissions for finding the deal. So you want to be able to differentiate that and really look at that through a certain lens of asking, how much skin does this person truly have in this deal? Next are asset management fees. Now, these range from 1% to 2% on a monthly basis off of the gross revenue of the property. So what is it for? It's the high-level oversight to ensure that the business plan is actually being executed. This includes looking over third-party property management companies, holding them accountable for performance, and essentially ensuring that the business plan goes to plan. To be more specific, their job is to analyze and scrutinize what was the forecast and what's actually happening. Is it on track? And if it's not on track, why is it not on track? And what are we going to do to fix it? So there's a lot of heavy analytics and problem solving and creativity that needs to be applied in order to be successful in this role. Let me give you some examples of what a good asset manager does. How many people are renewing their leases? Is that number getting better? Is that number getting worse? Why? Because if people don't renew, there's some type of problem. If that number is going down, that means people aren't enjoying the property as much. And every single time that you need to turn a unit for a new tenant, there's a lot of expenses that go into that. So making sure people are renewing based on your projected returns. How many new tenants are moving in? From what marketing sources? Which marketing sources are working to bring new tenants in? Which are not? Which should we stop? So it's analyzing that. Leasing is such a big thing. How many people that are coming to see our apartments are actually signing a lease? If that number is not where it needs to be, if it's trending up or down, why is that happening? Is it a property issue? Is it our product? Or is it possibly a sales issue? The person that we have showing the units. They should be asking, how are collections and delinquencies? Are people paying on time? Are they defaulting? Why are they defaulting? Is it because we're not screening them properly before they come in? Is it because our prices are too high? Is it maybe the economy? There's inflation and people can't afford their bills. So there's a lot of thinking involved. So it's a matter of looking at the numbers, looking at the trends, and then really diving into what's causing the difference, and most importantly, how do we fix it? So as a passive investor, what you should look out for is anything that's over 2%. I'd be asking why. Now there could be reasons for it, right? Maybe it's a huge value add project with a ton of construction and they're not charging a project management / construction fee. But it's really about understanding how much complexity is in the asset management. So as an example, let's say there's a property being acquired that's only 50% occupied because it was poorly ran, and there has to be millions of dollars of renovations that go into it, and they have to get it from 50% occupancy to 95% occupancy. There's going to be a lot more asset management work on a property like that than a property that is already 95%, let's say, occupied, has stable income, and there's minimum improvements and renovations that need to be made. So this is the way I would be looking at what am I being charged for asset management, is how hard is this deal to manage on a monthly basis? The next fee is a disposition fee. Disposition fee is essentially selling the property and delivering a profit to the investors in the deal. That's the compensation for executing on the plan and bringing the exit strategy to fruition. So what goes into that, right? Well, there's a lot of market analysis and timing, right? Understanding when is the right time to sell based on demographics and economics, changes in the neighborhood, to really know when it's opportune. Preparing the property for sale, making the necessary touch-ups, the renovations, the curb appeal, making sure that prospective buyers are going to be more intrigued by it. Valuation and pricing strategy, right? Determining the right number to charge. Negotiation with buyers, working with legal, knowing when to get legal uninvolved, because sometimes legal will kill a deal as well. That negotiation process is so delicate and requires a lot of emotional intelligence and good negotiation skills. Also, overseeing due diligence, making sure that the buyer has access to the facilities, that they get a chance to underwrite everything that they need to underwrite, and communicating with investors throughout the process, explaining to them the key decisions that are being made before the exit, why things are being sold, for what reasons. And last but not least, also post-sale financial settlements, right? After the sale, the syndicator ensures that the proceeds are distributed according to the agreements, and that all the investors are happy and made money and the job was completed. Now, the three questions that you should be asking as a passive investor is, number one, in the projected returns that you marketed to me, is that already incorporated in the returns to me? So on a deal, there's something called deal returns, and then there's a net to investor returns. That's a red flag to me. If somebody marketed a 15, 17, 20% return, but didn't incorporate all these fees that we're discussing, such as the disposition fee or the asset management fee, to me, that shows lack of transparency. Because when I looked at that number, I saw 15, 17%, that's everything's been stated. Now, did I have to go into the fine print to see that after all these fees, my net returns are going to be lower? So that would be a huge red flag for me if I was passively investing in a deal. Refinance fee. This is going to range from 0.5% to 2% of the new loan amount. And the fee compensates the syndicator for the work that they're doing to secure new financing. This involves handling, networking with all the banks and the lenders for the best possible opportunities, submitting the right financial packages, orchestrating that whole process. There's a lot of due diligence that a lender is going to perform that needs to be provided by the syndicator/sponsor in order to execute that new financing. And that effort increases in magnitude depending on how complex it's going to be to get financing. Is it difficult to get financing on this property when we're going to refinance it? So for example, initially, if the deal doesn't qualify for traditional fixed financing and they need to take what's called a bridge loan, and the property is only 50-60% occupied, and it's going to take all of this work to get it qualified for fixed rate financing, then I could see the refinancing fee being a little bit higher. But if it's a very standard cookie cutter refinance where it's almost kind of a guaranteed approval, nothing's guaranteed, but let's just say high likelihood of approval, then I would be asking, why is this refinance fee so high, if it is high? Anything above 2% is an automatic red flag, and really you just want to have a conversation with your syndicator or sponsor. What is the reasoning? What's the rationale behind it? And I just gave you a little bit of context as to how you should look at it. Other questions that you should ask around the refinance is, how much are you planning for the rate to drop by? Is there going to be a return of capital to us as investors when the refinance does occur? So how are the proceeds from that going to be utilized? And most importantly is, have these fees already been incorporated when you presented me the net returns, or what should have been the net returns to me as an investor? So as I mentioned in my asset management video, if somebody is advertising 15-17% returns, but then in the fine print there's these fees, so your returns aren't really 15, 17, 20%, whatever that number is, then there's a lack of transparency. And now let's discuss profit sharing, waterfall structures. What is that about? So profit sharing is essentially when the deal is sold, there's going to be profit made. So there was $10 million put into equity by the investors and the sponsor, and the goal was to double that return. Then at the end of the hold period, which is maybe 3 years, 5 years, the goal is to end up with another 10 million in profit. So 20 million total. Now, usually these fee structures could range anywhere from 80-20, meaning the syndicator, the person that did all the work to acquire, manage, sell the deal, gets 20% of the profit. So in the example that I gave, they would get $2 million, and the investors that invested in the deal would get $8 million on top of their original investment. Now, there's also splits that are 70-30. There are splits that are 60-40. So what constitutes these differences in fee structures? Number one, it's the experience of the syndicator. How many transactions have they done? How successful they've been in delivering profits to investors in the past. Because in this business, what you're really betting on is the person behind the deal, not just the deal. You could have an incredible deal, but a bad operator, and that's going to be a problem. So the more of a track record a sponsor has, they've earned their right to charge more money because they are more proven in the industry, meaning they are a safer investment for the investors investing into the deal. Number two is their ability to access capital. If I am a syndicator with a great reputation and I get hundreds of calls of people that want to work with me, I have referrals, or I could send a simple email out and 100 people are going to reply back and say, hey, I'd really love to do another deal with you. That's going to be a different position and situation than maybe somebody just starting out in the business that has 10, 20, 30 people that they can call. So it's really also access to capital. Now, what is the profit sharing for, right? Well, it's for finding the deal, managing it, executing the business plan, and selling it for a profit. But wait a second, we just discussed acquisition fees have been charged, there's asset management fees that have been charged. All of these things that I've just mentioned, they've already been charged for. So why are they being charged again? Here's a little insider trade secret. It's really just a continuation of all those fees, but now in a profit sharing arrangement, which is good because this is the compensation part of the deal where the interests of the passive investor and the syndicator are aligned. Essentially, the syndicator is only making money off the profit sharing when the investors in the deal are making money, as opposed to some of the other fees that I've discussed earlier, which are happening either when the property is acquired with the acquisition fee or on a month-by-month basis when we talk about asset management fees and those reoccurring charges. So the next question is, well, why am I being charged for these fees in the beginning and then at the end, if it's really for the same scope of services? Well, the answer is really simple, because it's really just breaking up the total compensation to the syndicator into two parts, right? Some of it as we go, right, for all the work that we're doing before the deal is sold. And the other part is when we actually execute everything and deliver those profits, we want a piece of what we were able to execute on. So some people may ask, well, why charge anything as time goes? Why not charge everything when the deal is sold? Wouldn't that be in the best interest of the investors? And absolutely it would be, right? Me, if I was a passive investor and somebody said, look, I'm not going to charge any fees up front, I'm not going to charge any asset management fees, I'm only going to make money when you make money, that would be great, right? Because there's a lot of alignment of interests. However, it's also unrealistic in many cases because it's impossible for the syndicator to actually run the operation. Remember, it takes 3, 5, 7, maybe even 10 years before a property is sold, depending on the business plan, right? Usually the industry is 3 to 5 years. So imagine not making any money for 5 years. It's going to be very hard to pay for legal expenses, office, rent, marketing. So that's why there needs to be a portion of the money being collected as time goes and a portion at the end. So this way everybody wins, the syndicator and the passive investors that committed their money into the deal. Now, keynote, what I'm looking for as a passive investor is what's the balance? How much am I being charged in the beginning and in fees? And how much of it is on the back end? Whenever I see a lot of fees in the front and a small profit share in the back, that's a red flag. So you want to look at it in the lens of, are they trying to make all of their money up front before this deal is actually sold and profitable? Or are they trying to cover their expenses and run their business so when they get to the exit, the owners and other people involved, the executive team, can make a profit off the deal? That's the lens that I look at. So if somebody says, I'm going to charge you a 5% acquisition fee, a 5% asset management fee, but I'm only going to take 10% of the profit sharing, I would run. Now, that's not usually the case. Most people that I come across have great integrity. Everybody knows that really the only thing you have in this business is your reputation. It's not about doing a deal or two. It's about doing hundreds of deals, thousands of deals, and building a real estate empire. Most people are future focused. However, there's always bad apples in every industry, and I hope I could deliver you with some valuable information on how to be able to spot those things and avoid some of these common pitfalls. If you want to know more about Aligned Ventures and some of our investment opportunities, visit our website at investav.com.